share my screen.
Don't get offended if I mute you, just so we don't have background noise.
Yes, if everyone can mute themselves at this point, you're welcome to put questions as you go in the chat, and then we will have time to open it up for spoken out loud questions at the end of the presentation. All right, Anna, take it away.
Good morning, everybody. Like Jennifer said, I'm Anna Gettman. I'm an escrow officer at Chicago Title. I've been doing this for approximately 24 years. Started as a receptionist, went to title department for a little bit, and then felt like escrow was going to be my gig, which it is. So today, I just want to do a little bit of couple housekeeping items. I tend to talk very quickly. So if I'm talking too fast, just put in the chat, please slow down. I'm happy to slow things down. I get excited about the material that I'm going over. So I get very excited and I start talking very quickly. Like Jennifer said, any questions, throw them in the chat. They're going to be monitoring that for me. And so I'm happy to answer any questions along the way. If you have any scenarios, happy to go over those as well. So today, our agenda, we are going to be covering the documents we need for verification in regards to all of the entities that typically purchase real estate property. And so we'll go over those items. Why the Secretary of State status is important in corporations and LLCs in order for them to complete a real estate transaction. Who can sign as a buyer and a seller? And we'll go over those authorized signers and what we're looking for. Rules regarding Form 593 and Form 1099. There's a misconception that if you're an entity, you're exempt on certain forms, and so we'll go over that. Disbursement of funds, how those funds will be dispersed at the close of escrow in regards to the entities. Dealing with the deceased in a corporation, partnership, or LLC, and other challenges at closing. We can answer questions along the way, but we will have an opportunity at the end of the class to go over any questions that you may have. Okay, so I hope that's exciting enough for you to be here today. So we're going to start off with what documents do we need for verification. This will vary based on the type of entity. But in general, we do look for corporate documents that establish the signing authority for the entity. So in your preliminary title report, depending on, and this is just basically for a entity that is selling a piece of property. I'm sorry, scratch that. If we have the information for the buyer, sometimes you pull prelims before you have a buyer. But if you have a buyer and seller and we're reflecting the buyer in a preliminary title report, this too will be the same for a buyer that's an entity. So in the preliminary title report, towards the end of the exceptions, title will line out the list of documents that they require to be submitted and reviewed before we can move forward on the transaction. So don't fear if you are not sure exactly, even after this class, exactly what you are going to, or your clients are going to be asked of and for. It will be lined out in the preliminary title report, a list of the documents that are required in order for the transaction to move forward. So for example, articles of incorporations, bylaws, operating agreement, partnerships agreement. There are times I'm seeing it a little bit more now in the last couple of years. It was a little strange for me to see initially a couple of years ago, but within an entity, a corporation, some of the signers are actually trustees of a trust. So a trust is acting as an officer within a corporation. And so we have officer signatures and trustee signatures of a trust that's acting as an officer of the corporation. So it can get pretty sticky. So when we ask for those documents, it's best to provide, just encourage your clients to provide those documents as soon as possible, especially in scenarios like I just mentioned, because guess what? We now need additional documentation. So if we were given the corporate documents, you know, the articles of incorporation and the whole shebang, and we see within that, within those documents that a trust is acting as a officer of the corporation, guess what? We're going to ask for a copy of that trust. And typically people say, why do you need a copy of the trust? They're not on title. Well, they're an officer of the entity that is on title. So again, it's really a good idea once we request those documents to get them to the escrow officer as soon as possible, because you just never know if that is the situation, because I'm seeing it more often than not in the last couple of years. So why is the Secretary of State status important to corporations, LLCs, and in real estate transactions? So the state of California regulates these entities with, just like anything else that does business in California, there is a regulator. We ourselves are regulated by the Department of Insurance. So entities are regulated by the Secretary of State of California, and they have guidelines and policies and procedures that they have to abide by to be able to conduct business in the state of California. Now, we do come across with entities that have filed their entity in another state. That does not mean that they cannot conduct business in California, but they have to pretty much check in with the state of California in order to conduct business in California. So what we do in the title department is we check these entities that are buying and selling in the particular transaction to see if they are in good standing with the state of California. So our title department has a website that they go in and they just type in the kind of bare minimum, because as you know, there's entities that have similar names. And so they'll go, that way they can get a wide variety list, because sometimes if they type the exact name in and sometimes the characters could be too specific and the computer just says, whoa, 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 I don't know what you're talking about, and brings up 0 results. Well, we don't want that to be misconstrued as that entity doesn't exist and is not in good standing. So what the title department would be, if it's ABC Lending Investor LLC, they would just type in ABC, and just that way they can search for that entity, click on it, and it'll tell the title department that that entity is in good standing. If they are not in good standing, it will tell them that they are not in good standing, and it will give them a very brief explanation of why they're not in good standing. So if they're not in good standing, we're going to advise the customer that they're not in good standing and that they need to get themselves in good standing with the state of California. And we can provide them the brief explanation we were given. But most likely that entity, that officer of that entity, will have to contact the state of California and figure out why they're not in good standing. So the multiple reasons why they could not be in good standing would be they haven't filed their taxes with their state and or paid if they're delinquent, or the state, it's not like what we have when we call it a statement of information. The state of California has a form that they too call a statement of information. Don't get it misconstrued or confused of what we say we need an SI, a statement of information. It's completely different. It's not the same thing. It's not our form. It's a form that they require to be current and up to date and on file with the state of California. So that's another reason why they wouldn't be in good standing is their statement information is expired, hasn't been updated, or is not filed with the state of California. So those are the few items that could flag the entity and for it not being in good standing with the state of California. If those items do arise and those situations do arise, that entity must rectify those type of situations and bring themselves back into good standing. They will be suspended, so put in suspension until those items are rectified and taken care of, and will not be allowed to conduct business in the state of California for your real estate transactions. So again, we would take care of this typically at the beginning of a transaction, because some of these items that they have to take care of with the state of California can take some time, i.e. file taxes. And if they file the taxes, I've had an entity where they didn't file taxes for a while, decided to start doing business in the state of California, didn't realize that that was something that they needed to make sure they were good to go, and tried to get to a real estate transaction. And it was actually delayed quite a bit because they had to file taxes that for several years that they hadn't filed. And, you know, you're kind of at the mercy of other people and third parties and that really don't have an interest in the transaction, that they have their own timeframes. So why is it important for us to get all this information up front? You don't want it to delay your transaction, especially if you're dealing with a new entity that hasn't conducted business in a while in the state. They may not even know that they are not in good standing. Maybe that statement of information that is expired or not on file is something that they didn't realize that they had to keep current. So, and that too does take a little bit. It may be something sounds so simple, but they have to turn it in. They have to, you know, deal with the state of California, and the state of California Secretary of State's office. They're kind of on their own time frame too. So, again, get us information as soon as possible. Okay. So other guidelines for these transactions. So when we say self-dealing, for an example, that an LLC, it's if we see something that the LLC is selling to themselves as an individual or the corporation, those are the type of things that we need to like stop and ask questions. So, you know, that it's typically not ideal or not done when a conveyance or mortgaging of a land by or to an officer of corporation or a member of LLC. It's not something that we like to see, or it shouldn't be seen or be done. So no self-dealing, self-serving type of situation. It's almost like the whole, I don't know if any of you have taken our trust class, same thing, self-serving type of conveyances from a trustee to an individual that is serving as a trust type of situation. So the next item that we kind of come across every so often is foreign sellers signing. There is situations where a person that is a officer and a signer of an entity is located outside of the United States. This is not to be confused as an individual foreign seller, but they do have the same type of guidelines as far as like for signing official notarized documents. Signing officers signing in a foreign country must follow the same guidelines as any seller in a foreign country. The entity must be filed in the state. So if they say I'm outside of California, I'm not required to do what the state is required for an entity filed in the state, it's not okay. That's not how it goes. And then also to keep in mind that if you do have an officer that signs for the entity that is located out of the United States, they have to abide by the same regulations and rules that we have for any individual sellers signing a notarized document. They must have it signed by a notary public at the U.S. Embassy or U.S. Consulate. That does take some time. It took some time before COVID. Now we live in a COVID world. Can you imagine how much more time it would take? Prior to COVID, it would take at least 30 days to even get an appointment in the U.S. Embassy or Consulate to get those documents notarized. They don't explain the documents. They don't, it's not like your normal notary signing here that is done and the notary kind of goes over what they're signing. They go in, they say, they present the documents that they are to be signed, and they are signed in front of the notary public, and the notary public notarizes the documents. So it's not like a full-on signing. The reason why I want to mention this is if, people do travel, people are located outside the United States. I want to give one, as Jennifer said at the very beginning, I have seen a lot, and I just recently closed an escrow where a signer was located in Hong Kong, and he could not get an appointment with the embassy because of the COVID regulations and just everything. I closed it finally 9 months later. So again, we need to know this information ahead of time if somebody's located outside of the United States, so we can maybe start working on these things, start advising the signers that what, tough road they have ahead of them. But I do want to make a note that it depends on the country that the signer is located in, because some countries are a little bit easier than others, depending on their regulations and their availability and appointments at the U.S. Embassy and the U.S. Consulate. Confirming capacity. All signatures and instruments that we are relying on, including indemnities and the notary and acknowledgement blocks, need to be properly reflected authority and capacity of signer. And what that means is when you turn in those entity documents, when we're reviewing them for several things. One of those items that we are reviewing them for is we're trying to find out who are the signers, who are supposed to be signing for this corporation, LLC, partnership, so on and so forth. If it's a one person signing type of situation, or if it's several. And then once we determine who is signing for the entity, we have to determine their capacity. If they are serving as a president, as a manager, as a vice president, as a secretary, as a partner, as a general partner, as a managing partner. So now you can kind of get the gist of there's different entities that have different officers that require different things. Some entities require the entire board to sign for that entity in a transaction. So we have to go through all of that, make sure that we know who's supposed to be signing and how, in what capacity. So when we get into a corporation, we do require what's called a corporate resolution. And what that corporate resolution is a meeting with the board of directors called, and it's basically stated in the corporate bylaws that this must happen for any transaction that the corporation is involved. And so within that meeting, they're presenting to the board saying, I should take that back. The corporation wishes to purchase this property, wishes to sell this property. Now, it needs to be detailed. That corporate resolution has to, number one, say what they're doing, purchasing or selling, how much the purchase price is, or what the corporation is selling the property for, and to whom. Because believe it or not, it does matter in those corporate, they can't just put a blanket policy or blanket corporate resolution saying we're selling this property and putting it on the market and it's going to sell for $500,000. It's got to be specific. So typically this corporate resolution is not provided to title until the transaction is well on the way. The buyer is established and, and they're approved and all that good stuff. And money's already been verified and all that good stuff. So that corporate resolution is provided, midstream in the transaction and must be signed by the authorized signer within that corporation. Typically, it's the secretary and or president. So it's just a one-page document that does not have to be notarized. And it just stating that a meeting was held with the board of directors and it's been resolved that this is going to happen. Property is going to be purchased, sold, X amount of dollars to whom, and and then it kind of, some corporate resolutions do reiterate who is authorized to sign in the transaction. But at the corporate docs, the bylaws, all that good stuff is very clear on that, and nothing has changed. No amendments have been done, then they typically do not. Okay. Limited liability companies, LLCs. Those are typically managers that are signers. So in corporations, they're presidents, vice presidents, secretaries, etc. In LLCs, they're typically signers are managers. So an LLC can be a single manager or multiple managers or multiple members, a single member. It all depends on how the entity sets up the LLC, but we review those LLC documents to decide or decipher if the person that is signing is a managing member or manager or member. It all depends on how they set it up and how they determine who's going to sign, how many of the members need to sign, and so on and so forth. Okay. Let's see. Partnerships. There's several different partnerships that can be created within the state of California. They are typically limited partnerships, general partnerships. General partnerships, of course, hence the word general is very general. I know it kind of sounds very obvious, but general partnerships typically are vague, and but I very rarely see them. I have seen maybe 2 in the last 24 years, but they do again tell us how the property should be conveyed or mortgaged in the same style or manner in which title is acquired. So if it's required as Robin Albert and Anna Gettman in the Albert Gettman partnership, like we can't switch things up. We can't, it has to be the way title is held. However, the signatures may be required, will be controlled by the state law or practice and by the terms of the partnership agreement. So what that means too is within that partnership agreement, it's going to tell us if the percentages were outlined in that agreement of how, for example, proceeds. If Robin is supposed to have 60% and Anna is supposed to have 40%, when we close escrow, we have to abide by what the partnership states in percentages. And Anna can't come back and say, oh, you know what, we changed our mind, I'm gonna actually get 55% and Robin's gonna get 44%. So those are the type of, that's another reason why the partnership agreement is reviewed, so we can get some clarity on how proceeds, assets type situations are to be dispersed. Limited partnerships, general partners of limited partnerships are agents of the partnership for purposes of carrying ordinary usual business of the partnership. So limited partnerships can only do certain things, and the partner may have authority to sign, for example, checks or certain documents, but they may not have the authority to actually sign to sell a property or to purchase property. So there's different partnerships where they give powers to different partners depending on what the transaction or what kind of business the partnership is conducting. So, okay. Earlier I had mentioned about taxes. I do want to say one thing. We do not provide tax advice whatsoever because we're not a tax entity. We're not licensed that way. Typically, if we are dealing with an entity buyer or seller, they typically are very knowledgeable when it comes to taxes for the state. And we don't deal with federal whatsoever. A lot of people are like, oh, what's going to happen with my capital gains? And first and foremost, again, we do not advise on taxes, but we don't deal with federal for tax purposes of selling. But on the 593C, which is a state of California franchise tax board form for any real estate sales, it's a 3-page document. It used to be separated in the past, and this is something new. So maybe the items that you have remembered in the past, it was like a one simple form. And then if you filled out that form a certain way, then you get provided another form, and so on and so forth. The state of California has combined several forms into one, which is now known as our 593. They've taken away the C. It used to be 593C. And the reason why they identified it is, again, like I said, if you filled out the 593C a certain way, you would be provided the 593E, and so on and so forth, but they've combined it into one. So a lot of the times, so the reason I scratch that, I don't want to say the reason. Entities are created to conduct business in a manner of, everybody's tax basis is different. Everybody's situation is different. Everybody may have a different reason of creating an entity to conduct real estate business in the state of California. And maybe one of those reasons is as far as the taxes, the franchise tax board, which is 3 3.33% of the sale, if you're not exempt to go to the franchise tax board at close. Well, the entities that conduct real estate transactions in the state of California are exempt per item number 6. The seller is a corporation. I know it's kind of tiny, but I apologize. The seller is a corporation and classified as a corporation for the federal California income taxes purposes. Item number 7 says the seller is a California partnership or qualified to do business in California, and so on and so forth. So those are the few items that they fall under and automatically exempt them from our withholding of 3.33% of the purchase price. So this could be one of the reasons why, on top of many, why they are conducting business as an entity. So this form does, even though we do not withhold, in the past, if they were exempt, the form just goes into our file for records keeping. We scan our file, and if the state had a question about a transaction, they would reach out to us and like, well, this is how the seller had prepared filled out the 593 and signed it, and this is the reason why we didn't withhold. That is no longer what we do now, and we are required by the state of California Franchise Tax Board. It's our fiduciary duty to turn in every single 593 on a closed transaction to the state of California, because then for their auditing purposes and just for the sake of not having to reach back out to the title company if they have a question about a real estate transaction. So that's why we have to have this form, whether the seller thinks that they're exempt or not. It has to be filled out and it has to be signed, because it is required to be turned into the state of California Franchise Tax Board at the closing for every transaction. And we actually have a time limit of when this has to be filled out. So it's a must to collect at closing. If not, typically you're not going to see this filled, the second page. This is the second page of the 593. This would only be filled out if the seller wasn't an entity and was not exempt from any of the other items, but they had a loss or zero gain. This second page would have to be filled out by an individual seller that is stating that they have a loss or zero gain. I know this is an entity class, but I'm going to go ahead and just give you a little bit more information on this. This used to be the 593E, which they've done away with all the other forms and combine it as one. So this is your second page. 99.9, I mean, this will always be blank for the entity because they qualified for those exemptions on 6 and 7. Okay. And then the last page is our signature page. And so the seller is required to sign the last page. And the top portion is if there is a withholding, an alternate withholding, so on and so forth. Again, if there is an exemption on the first page from items 1 through 9, sorry, 1 through 9, page 2 and the majority of page 3 will not be filled out. They will be left blank and the seller will sign and date for page 3. Okay. So I have not seen anything, I have not paid attention to the chat. So I'm assuming we have no questions so far. So I'm going to continue.
And
Okay.
Anna, I've got red flags up, but we didn't put in a slide about what happens if somebody that's a signer for an entity dies or is deceased and the corporate documents haven't been updated. Is there anything just briefly that you want to say about that? Just because I know dead people mess things up in transactions all the time.
Yes, that's very good that you made a mention of that because I have had, like you said, I've seen it all. Well, not maybe not all, but a lot. So if a officer is deceased of a corporation or a manager is a managing member of an LLC or a manager, a signing manager of an LLC or a partner passes, it doesn't, amendments and documentation have to be done just like anything else. If a individual owner passes away, you would have to figure out who is, if it's a joint tenancy and so on and so forth, it has to go to probate. But I've never had to see, I never have seen where a signer does pass away and some, you know, that situation goes to probate because these entities are built and written up in a way where there is catch-alls and what ifs, and if this happens, then this is going to happen. But a death certificate does have to be provided. So we very well can verify that that person is no longer living, that they're just like a partner's not trying to be, I mean, I'm just saying, like a partner's not trying to be shady and say, oh, we don't need that signature because he's dead already. And he's, you know, so we have to have a verification that that person is no longer living. And then that corporation or that LLC or that partnership, they have to get together and create amendments, addendums to their entity to say now what's going to happen if this person is no longer able to be a signer. Also, if they're incapacitated, maybe they're not dead and they're incapacitated and they just no longer have the ability, the ability to sign for that, to sign as a signer. That entity must get together and, you know, decide or figure out what's going to be done if that signer is to be replaced by another board member, another signer, or if that signer is no longer going to be, that signer's signature is no longer going to be necessary. And that amendment has to be created, written up, signed for, you know, approved by the board of directors or the other members of an LLC or other partners of a partnership. So if somebody has passed away or is no longer able to be a signer, we cannot take just verbal saying, oh, this is what's happened with that signer, they're no longer, da, 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 da. It's all has to be written up.
Thanks, Anna. We did have one clarifying question on the tax portion. If we aren't collecting the 3.33%, then does it need to be collected and sent in on those transactions or not?
No, the 3.33% does not get collected by us nor anybody else. What happens is when that entity goes and files their taxes the next year for the previous year, their CPA, whoever prepares their taxes or handles their taxes, will determine if they have any funds owed to the state of California for any of the transactions that they have, that they were involved in within that year of filing those taxes. So no one is sending that money in, because that is the whole reason why they are filling out the form, that they are exempt completely from that withholding within the transaction, and their CPA will determine if any funds are owed when they file their taxes. And so that's what kind of is like, oh, then, you know, they just have to worry about it later. But remember what I said earlier in the class at the very beginning, that they have to be in good standing. So if they don't file their taxes, you know, after they've done all of this real estate transactions, then that kind of puts them in. So there's a lot of checks and balances, even though we're not collecting that 3 1/3. At some point, it's going to be reviewed, and that's another reason why we're having to turn in the exempt forms now to the state of California, because state wants to make sure that they have all of their documentation in one place to make sure that all these entities are doing and conducting business appropriately and correctly. Okay. Okay, so red flags. So when we collect these documents and we are going along our merry little way in our transactions, you know, there are checklists that we have as escrow officers and our title officers have, that our underwriters have provided to them, that for every entity that we're dealing with, we have to check off to make sure they're in good standing and this, and, you know, their internal checklists. And some of those items are checked off when the documents are reviewed. So it's not something that we need to share with you as the public, because it's something that we make sure is correct within the documents, but there are those checklists that we have, and then we go through. So again, these are just a few items that we feel like it's important for you to understand and know. So if they do arise, then you understand why. So any recent change in the state filings of the entity that adds or deletes parties with the authority, or change in the partnership LLC agreement that attempts to do the same. So we need to know why. I know it's like, it's really none of your business, but no, we kind of do need to know why. Why is the status changing? Why are people being taken off? Is if they have passed away, okay, or they're incapacitated, okay. But we need to know what the situation is, so we know that we're not going to have somebody come after the fact and say, hey, that property was sold out from under me. I was part of this entity. I didn't agree to the sale and it sold anyways, for example. Earlier, I had mentioned the self-dealing. Any transaction that involves a self-dealing, the entity is selling to one of the officers. You know, if it's a single signer, and that, you know, but there's other members, and it's being sold as a single signer to that individual, but there's other members, it's kind of a little bit of a red flag. Like, okay, wait. And that's something that we would kind of look into on a partnership or a LLC, because remember, the corporation has to have a corporate resolution allowing the transaction and having a meeting to approve the transaction. Any recent amendment to the partnership agreement, adding or deleting parties to the partnership, same thing as above. We just kind of need to know why, and just saying, you know, it's just, we're conducting business where somebody doesn't want to be part of the partnership anymore, and that's a valid reason, and we're not going to say, we just need to know why. And any recent amendments, again, to the LLC agreement, adding or deleting members. So it does happen. People, it does happen. People are part of these entities, and they actually, for example, are not an active person in these dealings day in and day out. They may have a different job, You know, they may be a teacher and they have gone into business with a friend, and you know, things kind of start happening without their knowledge. So it does happen. And
Do we
we
ever
are
have to reach out to a party that's been recently removed to confirm with
yes,
them?
yes, we have. There was a transaction up in Shaver. They were removed. We needed to verify why, the reason that was given to us, why it was removed and why they were removed, and it was verified. And in that case, that person just didn't want, you know, they had already moved on to different things, and they didn't really want to be part of the entity anymore. And so they verified, and it's just a written statement. Okay.
Moving on.
More red flags. Any variation in name, no matter how minor, in the chain of title, documentation submitted to the chain to support the chain of title. If somebody got married or somebody got divorced, I had a situation where a husband and wife had they created an entity and they got divorced, and her name, she was still a signer in her married name, but they did some, you know, they borrowed money and she used her maiden name because she didn't want to use her married. So those are the type of things that it's like, whoa, 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 you can't really do that. You have to do the proper documentation, to do amendments to your entity documentation, to explain why there's variations in name. It could be the same person, but we need to know, again, we need to know what's going on. Why is the name changing? I.e., if it's a family entity that they've created and their older children that share the same names as their parents, could be an issue. Especially if a parent and child are signers, the adult child is a signer, and they have similar names. You want to make sure that everybody signing who's supposed to be signing, that has the right name, that are signing. So, and any recent conveyances without corresponding financing. So sometimes we see transactions where they are being financed and no deeds of trust, and corporations, you know, remember the corporate resolution, they have to approve. And the reason why they have to approve is because that money is coming from their, you know, their assets. So that's really not a big red flag. What a big red flag is if a transaction maybe is being sold and the entity recently paid off a loan that was on the property, but there was there wasn't another loan replacing it, meaning they got money from another, and then a reconveyance was filed, and it just kind of didn't add up. Like, okay, this was a big amount to be paid off, but there was not another loan that was put on to pay it off, but there was a reconveyance. So those are the type of things that we kind of just say, whoa, 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 whoa. We need to know like how this was paid off, because there is no following deed of trust supporting the financial payoff. So I went through this pretty quickly. I told you I talk really fast. So unless I'm really on time, we only had an hour for this class, correct?
We only had an hour, so you are right on time. And so we can open it up to any questions. If someone would like to just unmute and simply ask a question, this is your time to do that.
I was just going over the
Either we did such an awesome job of presenting this information that everybody feels ready to go, or we accidentally put people to sleep. But I'm sure that's not the case. So, so we'll just wrap up with saying thank you, Anna. Great job. And you covered all the things that I was curious about. This is the first time that we've done this particular class on Zoom, so it's always a little bit of a hurdle getting everything put together, and you did an amazing job. And again, if you've got questions and need follow-up, Anna's information is on the screen right now. Or
And Ian has a question right now. Ian,
okay,
go ahead,
Yeah.
Ian.
I have a question. You guys handle an entity buying like seller financing or subject to deals?
Okay. So the buyer was an entity and the seller was an individual?
Yeah, yeah. And it's a
Okay.
seller financing or a subject to deal.
Okay. And, or were you the one that says that we withhold, we withheld?
No, I'm not.
no, he was just asking.
Okay, so what would happen if that was the case?
Yeah, yeah. And do you handle those kinds of transaction in Chicago?
Oh, yes, yes. But let me just paint a really quick scenario for you. If the seller is an individual and the buyer is an entity, and the buyers and the seller are doing a seller carryback where the seller is carrying a note.
Yeah.
Or then at that point, since the seller is carrying a note, they would fill out the 593 withholding accordingly. And depending on how they filled it out, of course, we can't advise them how to fill it out. They could do the whole withholding of the 3 1/3. They can choose an alternate withholding, or they can just withhold within the amount of that proceeds that they're receiving above and beyond the seller carryback. But just also note too, that if they choose to do one of those things, the buyer would be responsible to send every month that the buyer makes a payment to the seller for that carryback. They would be responsible to send a portion of that payment as a withholding to the state of California. So in those cases, we would strongly advise that seller and buyer to consult with a CPA, a tax, professional, so they both understand that scenario. Because guess what? The buyer automatically becomes responsible for that withholding for that seller to be sent every month to the franchise tax board. So that's just an extra, hey, did you know? But yes, we do handle those transactions.
Okay. So you're talking about the monthly you're talking about is taxes?
Yes. So if the seller filled out the 593 and didn't have an exemption at all, then the buyer would have to be notified that those payments, say you're the individual seller and I'm the entity, and it really doesn't matter if it's an entity or just an individual buyer, but and we decided that you're gonna do a seller carryback for $200,000 and my monthly payments are going to be X amount of dollars. Well, say my monthly payment is $1,500, but that buyer has a fiduciary duty now to make sure that the franchise tax board has their withholding from the seller's proceeds, because essentially that monthly payment now is the seller's proceeds. Even though they did a seller carryback, they're getting their proceeds in increments now. So I'm the buyer now. It's my responsibility to send the amount of withholding that is determined of that $1,500 to the state of California franchise tax board. So for example, just taking numbers, it is determined that $200 of the $1,500 is required to be withheld. So I would send, as a buyer for you, I would send the $200 to the franchise tax board every month, and I would send you your $1,300 payment for the seller carryback.
Okay.
This is something that I've seen twice in 24 years, but it's something that we need to put out there, like, hey, did you know, type of thing. Because if the seller does a seller carryback and is not exempt in any of those items 1 through 9, that could be a situation.
Yeah, that's good to know.
Mm-hmm.
Oh, okay.
Okay. All right. No more questions? Any more questions? It's almost a weekend.
I know. Well, then we will conclude this. We will have the recording available and sent to all participants later on today. And we will also be posting this video to our YouTube channel on Chicago Title Fresno. So thank you again for taking the time out to attend today. We look forward to seeing you at our next class. And thanks again, Anna. Great job.
You're very welcome. Thank you.
Hi, everybody.